Hello everybody, hope you're all doing very well and welcome to this educational technical analysis video for you all today, where I'm going to be covering in great detail the trader's stop loss. I've had a lot of comments over the last few weeks of people asking me what exactly is a stop loss, and secondly, they find themselves buying Bitcoin and placing a stop loss below where they've bought in, only to find themselves getting stop loss hunted, where the price will be moving along and then suddenly you will have a wick down, and the wick will be triggering people's stop losses only for the price to then move back up in the direction they have been predicting. And I can see how that's very annoying. So I'll be going over in this video how I personally use my stop losses, and I have a very successful trade rate with using them. So I hope you can learn from how I do my own stop losses. So let's get into this. Just so you're aware, I'll be covering a great deal of examples. I'll be going over might as well start with the descending triangle and how you can be placing stop losses for buying and selling, so long and short, on the descending triangle. I'll be going over Elliott wave stop losses and how will be placing my stop losses when entering an Elliott wave trade, and maybe Fibonacci and horizontal resistance and supports as well. Okay, so there'll be a lot of examples in here for you all. So let's start straight into it with how I will be placing my stop losses looking at a Elliott from a Fibonacci descending triangle way. Okay. So firstly, I would be taking my Fibonacci retracement. For just a random example here, we'll be taking our Fibonacci retracement from the top to the bottom. And then, as you may not be aware if you've been watching my videos, I like to go short on the 0.618 Fibonacci level. Okay, so this level right here, I like to go short. And how would I be placing my stop losses? So taking a look at our descending triangle for Bitcoin, which obviously been playing out for now several, like 9 months, this is a very valid resistance trend line. Okay, so what I done on this move up, I was looking at the 0.618 Fibonacci level, and I entered a short on this 618 Fibonacci level. And what I done is I had a stop loss placed just above the descending triangle resistance line. Okay, and obviously I'd be playing that down with opening the short here. My aim was to play that down to 6,000 support. Okay, so that's very important, where you have, before you enter the trade, you have your target of where you're playing it to and your stop loss for where you are willing to get stopped out and essentially lose a few percent for the aim of gaining several percent. Okay, and what I like to do when entering a position is taking here a long position or short position, depending on whether you're playing from the bottom of the triangle or to the top. What you do is you take your, here for example, your short position, and you're placing it where you're buying in. So I'm buying in on the 618 Fibonacci level, and I'm going to try and play this down to the lower support. Okay, and my stop loss is placed just above the descending triangle resistance line. Okay, and what I mean by stop loss is here, when you're selling Bitcoin, this is where your stop loss would be. Essentially, if the trade moves against you and not how you were foreseeing the move, you essentially will take a little bit of loss instead of the price coming out of control and being in a very underwater position. And by underwater position, I mean taking a massive loss. Okay, here if it moved back up to 10,000, you'd be taking like several percentage loss. You'd be taking like a 20% loss. Okay, whereas if you've got your stop loss set here with only a 2% loss, it's just a risk management tool. You always want to be, as a trader, you always have your risk management set. And here is a very nice example of how I would have my stop losses set, with entering a short position, playing this down to the very lowest support that we have here, and obviously having my stop losses placed just above the resistance. So for instance, on this trade, for the example, I'd be risk losing 2% with the potential of my target to gain 30%. Okay, so that's just how this stop loss, this long position or short position works. It will tell you exactly your risk to reward ratio with when you're entering your position, with by going by where your stop loss is placed down to where your target is. And you can see here, it actually in the end moved down 30%. So gaining 30% with the risk of losing 2%. So I hope that explains going short using a descending triangle. And now let's do the same theory but going long. Okay, so here we're buying Bitcoin. So what I'm doing, zooming in here, and we're looking, and we know that 6,000 support has been a very long-term support for Bitcoin, okay? And we know this 5,800 region, 5,800 to 6,000 is a great place historically to go long because it is a very big support. So let's look at this candle here for an example. We could very safely buy here, have a limit buy set at 5,800 as our buy, and we can be very safely then be trying to play this up to again the top of the descending triangle with our stop loss placed here below support, because we can very safely here be buying with our target obviously the top of the descending triangle. So we'd be placing our long position entering here 5,800, trying to play this up to the top of the descending triangle with taking our stop loss set below support, okay? So you can see this is definitely below support. So we are playing to a potential 26% gain with the risk of losing 3% here on this trade, okay? So you see what it means. Basically, if we did not have our stop loss set here below support and the price actually ended up moving up a little bit and then crashing downwards, let's say it crashes down to like $4,000, $5,000, you are then obviously stuck in your position where you are massively underwater and you've lost a lot of money, okay? So let's say it moved down to like $3,000 and you've lost 50% of your money, okay? If you have no stop loss set. Whereas if you have this stop loss set, you would have only lost 3% of your money, okay? So it's very important as a trader to always have your stop losses set before you enter the trade. Know where you're setting them and know where your target is, okay? So I think that highlights the stop losses of how I place them on the descending triangle. And now I want to cover Elliott waves, of how I would place them on an Elliott wave. So I'll go over a live example in a minute, but essentially, obviously going by our Elliott wave rules that we know that even if you haven't watched my Elliott wave lesson video, I recommend you take a look at that, because I go over it in great detail. But for a light example of Elliott wave and how I'll be placing my stop losses, first on the wave 2 and 4 corrections, obviously where we're looking to buy back in, I would be placing my stop loss, for instance here, be taking out our Fibonacci retracement, drawing that up to the top of wave 1, and as we can see here, just for an example, the price here is hitting more or less the 0.78 Fibonacci retracement, okay? So it's hitting, say, the 0.768 Fibonacci retracement, and we're buying in here on this Fibonacci retracement, okay? So we've bought in on our Fibonacci retracement tool, and we are now thinking on our Elliott waves. We know as a rule, wave 2 cannot retrace below the start of wave 1. So we can very safely be buying in here with our stop loss placed here just below the start of wave 1, because we know if the price on Elliott wave moves down, if wave 2 got to here, well, obviously it wouldn't be an impulse wave up. So your Elliott wave that you are expecting to be an impulse wave up fails, and we are actually looking at a correction, okay? So that would be a very well thought out trade going by Elliott waves if you were to buy in here with your stop loss placed below wave 2. Okay, sorry, below the start of wave 1. And second example would be looking at wave 4 correction. Obviously, we would be again for here. I'd be looking at wave 1, the top of wave 1 acting as support. We know that wave 4 cannot retrace into wave 1. A candle cannot close below wave 1 territory. Okay, so here you could be very safely buying in, knowing that you could place your stop loss below the start of wave 1, and if wave 4 was going to retrace that far, you would know again that your wave count was incorrect, and again it's just a way of so for instance here you'd be taking your long position, buying in here, aiming for at least up to the top of wave 3 if it's truncated Elliott wave, with your stops placed here. So for instance here you'd be risk losing 3% with the gain of potentially 15%, 30% gain, sorry. And now for a live example of how we could be playing that out. Let's obviously I see how the live examples are helpful. So we are auto scaling in here. Here let's just look at the 1 hour chart and see here how we could draw our Elliott waves. So let me actually really quickly zoom in here. So we would be taking our Elliott waves and going wave 1, 2, 3, 4, and then obviously we're now in the middle of our 5th wave, it would seem, no? And what we could have been doing here is very easily taking noticing on the wave 4 downwards. Let's say we bought in here, so not at the very bottom of wave 4. Let's say you were a bit cautious and you bought in on this support that was around here. Okay, so you've bought in here, and you know from your Elliott wave rules that the wave 4 cannot retrace into wave 1. So this is your support line, and so you could very safely buy in here on this candle with having your stop loss placed just below the start of wave 1. Okay, just by going by our Elliott wave rules, we know that wave 4 cannot go down into wave 1 region. Okay, so here you'd be taking your stop loss, buying in here, but playing up to at least the start of wave 3, but hopefully how I'm playing this is going up to 6,900 with your stop losses placed just below. So here you're looking at, say, a 5% gain with risking about 1%. Okay, so I hope that makes sense on an Elliott wave count of how you'd be placing your stop losses. And lastly, I want to go over very quickly here how I would be placing my stop losses on a horizontal support. And this is how I know many people are getting wicked out of their stop losses, or like stop loss hunted, and this is the main thing people have been contacting me about. So here we'll go over, let's just take like a random example here. I don't know, just a really random example. Let's be looking here we're looking at the 12th of September, and let's say, I don't know, let's say we're buying in here. Okay, so we're buying in on this candle here, and this is how I believe most traders would be playing it. They are, say, buying in here on this candle, and they are looking at the most recent support. So we've bought in here, and maybe most people would be thinking, okay, so our last low, most obvious low here was we move up, we move down, we move up, we move down. We're expecting the price to then go up again, okay, with several lower highs. And maybe they would be placing their stop loss here, and they would be thinking, okay, I'll have my stop loss placed here on this candle, that if it goes below, okay, we are moving down instead of continuing the range up. Okay, and as you see what happens, so in the stock market, I've been trading a very, very long time, but in the stock market, yeah, this would be a good tactic that would most likely work, especially if you're trading big company stocks, or if you're trading, for instance, in forex like the USD market or Euro market. Then this would be actually a great tactic, because you don't get it in as much in those as you do in cryptocurrency. But what happens in cryptocurrency, because it's so highly leveraged, you can be playing like 100 times leverage. You do get these very big wicks occur, and it's just something that happens because of how big the leverage is, and people getting like liquidated, for example. So what happened here is, if you would have had your stop loss placed, you would have been stopped out by this candle here, and you see how really quickly you would have been stopped out before the actual move up continued as you were predicting, but you would have been stopped out by this candle. And that would obviously be very annoying, and then you are in the position of, okay, do I now enter in back higher? Do I stay out of position? And this used to happen to me when I first started trading cryptocurrency. So I learned from experience that I couldn't place my stop losses so tight as I would in stock trading, because it doesn't work in the highly leveraged cryptocurrency market. So what I would be doing, instead of having such a tight stop loss here, I would be having my stop loss placed at the last swing low. Okay, well, not the last swing low, the first swing low, which obviously this time was 6,140. So as I would imagine most sort of newer traders maybe, or some traders would be placing their stop loss here at the swing low here, where obviously we had a first high, move down, high, move down, high, and then they would maybe expect of this to be the next lower candle, and then keep moving up sort of like this. Yes, you would have actually been predicting that right, where the move obviously is continuing up, but you would have been stopped out by this candle. So what I would do is place my stop loss at the lowest candle from the original move up. So I have my stop loss placed here, and that way I am giving myself, obviously there's more risk involved. So let's say you are entering into your long position here on this candle with your original stop loss placed here, you're risking only 0.43%, and you'd obviously be trying to play that up to however high you'd expect the move to go. But what I would do is actually place my stop loss below the recent, well, not the recent, the start of the lows, and then I'd be playing that up if I was confident in my long trade. Okay, and that you see here, I am actually risking 1%, so I'd be risking 1% of the move up. But a newer trader, I think, would be placing their stop loss here, a very small risk. They're risking themselves 0.2%, but obviously they're getting stop lossed out of their trade, and in the end they would have actually lost money from being stop lossed out here, and then they would have been annoyed as the trade actually went again how they predicted correctly. So what I would recommend to you is, if you're trading in the obviously do your own technical analysis and try and work this out yourself. But how I play this is with a little bit of a bigger risk. It's still obviously not a massive risk here, but with a little bit of a wider gap, so you're giving your space more space in case you get these big wicks down. So I'd place my stop loss here, with obviously the potential of, however, yeah, maybe you'd get in here a Elliott wave count, or you'd be using your Fibonacci extensions up to horizontal resistance for your price target. But yeah, that's how I'd be placing my stop loss for protecting myself, knowing that if the start of the low was taken out, I can very much expect a bigger move down to continue to possibly, like, say, 5,800 support. So I hope this video explains to you the importance of using a stop loss, so you're not being in a position where you are losing several percentages of your positions, and also so you're not holding an underwater bag, essentially. So it's a very, very important risk management tool that you really need to understand stop losses, and how and why you should be setting them. So I hope this has helped you. As always, any questions at all, just leave me a comment or drop me a personal message, and I will help you out to the best I can. I enjoy helping you, so no worries at all, just ask away. And with that said, thank you so much for watching this video, and I will see you in the next technical analysis. Thank you so much. Cheers. Bye.